Welcome, everybody, to today's Investment Consultants Forum. My name is Hank Kim, and I'm NCPERS Executive Director, and I'll be acting as your host for today's webinar. Today's webinar is part of our Center for Online Learning, which provides remote continuing education to public pension trustees, staff, and other fiduciaries and stakeholders. Today is the inaugural Investment Consultants Forum. The idea for this forum originated about 6 months ago. The concept was, with the anticipated choppiness of the economy, there must be a desire among public plan leaders to hear from a panel of investment consultants to supplement the information that they're getting from their own consultants. NCPERS is fortunate enough to have most of the leading consulting firms as members, and we asked them about the need for this type of education and whether they would be interested in participating. The rest, as they say, is history. With close to 225 registrants for this inaugural forum, I think it's safe to say we touched upon a real need. So we'll host this forum twice a year in the spring and autumn time, with follow-up in-person sessions at the ACE and October financial, actuarial, legislative, and legal programs. So stay tuned. We're very excited about this new concept, and hopefully you'll agree that this is needed and are excited about it as we are. Lastly, before we get to the meat of the matter, we do encourage audience participation. So please post your questions to the panel using the Zoom Q&A platform. We will get to all of your questions, but we will hold them probably till the middle or end of today's session so that we can get to all the interesting topics that we've been talking about. So let me quickly introduce our panelists, and then we'll get to the questions. Katie Comstock is a partner and public sector solutions leader at Aon Investments and has worked within the investment consulting practice for over 15 years. Her primary focus is consulting with public pensions on governance, investment policy, asset liability analysis, and asset allocation reviews. A public sector solutions lead, Katie coordinates the firm's strategic efforts across solutions, thought leadership, and market presence. Dan Johnson, Director, Institutional Advisory Services at Mariner, is responsible for the direct management of his team and their advisory and firm initiatives. In this role, he works with firm management to create, educate, implement, and enforce various policies and procedures along with best practices to ensure the consistent delivery and quality of the firm's services, interactions, and deliverables. Leo Festino is managing principal at Meketa. He is an active leader at client board and committee meetings, equally capable of working with trustees and staff. He has demonstrated track record helping clients set investment policy and asset allocation, and review and select managers and products in traditional and alternative asset classes. Julian Regan is Senior Vice President and Public Sector Market Leader at Segal Market Advisors. He has over 30 years of investment industry experience. Julian serves on Segal's Public Sector Leadership Group, where he helps to lead the firm's initiatives. He serves as lead investment consultant to International Union, multi-employer, public sector, state and local government plan sponsors. Welcome, everybody. Thank you for joining us for this inaugural program.
Thank you.
Dan, let me start with you. So we're going to start with a couple of questions. First on the fiscal side and a couple of questions on the monetary side. And the first one, as I said, Dan, goes to you. With the new administration and Congress bringing sweeping changes to federal priorities, what fiscal or regulatory policies do you think public pension leaders should be most mindful of in the coming year?
Well, great question, Hank. Thank you very much. Before I get started, I just want to say thank you and congrats to everything that NCPERS is doing to help all of the different members of the organization, and honored to be a part of this initial consultant panel today. So thank you very much. I do think that's a great question. Obviously, fiscal regulatory policies are certainly under the microscope. You know, we hear a lot about tariffs. We hear a lot about trade wars, focus on renewed critical lens of focusing on government spending and also the monetary policy aspects, as we know with the Fed meeting and announcement that came out yesterday. So I do think with these changes, there's a lot that the pension leaders need to be aware of. So obviously we'll get into a lot of the investment concepts. I do think from a higher level, what we can be aware of is renewed focused on cost of governmental plan sponsors. So unfunded liabilities and rising cost to plan sponsors, contribution requirements. I think you all put out a wonderful study that was a great aggregation of data across plans across the country. And it's something that I actually heard a lot of discussion about and board meetings across the country as well. So when we have things like, DOGE and focus on cost cuttings nationally, I think at a local plan level, you do see public pension leaders are being mindful of these items as well. So the things that we've seen in the past, the continued reduction to assumed rates of return and discussions on mortality tables. I know you all will be conducting a big study on that. We've seen a lot of plans take all that into consideration as well. From there, obviously looking at the investment program to make sure the things that they can control are certainly within their control. So focused on fee reviews of the investment vendors and making sure that the asset allocation and risk postures are together in a way that can help the plan meet or exceed those assumed rate of return. So I think a lot of good things have happened over the past that have set us up to address these renewed questions from regulatory policies. There's a lot of fiduciary oversight. Good things have happened in the industry. Again, we have a healthier retirement system here across the country with the significant lowering of assumptions and reduced costs throughout plans. I think that's stuff that will continue to be the case. And I think looking at monetary policy and looking at investment opportunities as they arise, making sure that there are good, prudent decisions that come into play, helping them achieve those lower assumptions and achieve and exceed their goals going forward will really start to play out in a very, very constructive and positive way.
Great. Thanks, Dan. Katie, next one is to you. So as we all know, over the last few years, there's been an increased instances of pension investment decisions getting in the political spotlight. How do you anticipate legislative changes will impact public pension investment strategies?
Thank you, Hank, and thank you to NCPERS for having me on this panel. Very excited to be here. I know most plan sponsors listening get very excited when legislative season comes around and to see what is potentially on the horizon for them to have to deal with. So I'll start with the high level, answering the question, the impact that we see of legislation on investment strategy. And the legislation generally has a tone of restrictions, whether it be a restriction on a particular country or sector or specific securities. That's the general tone. And what that does is it narrows the opportunity set that investors have to invest, ultimately leads to, theoretically, a less efficient portfolio. So ultimately, the preference is to leave the investment decisions with the investment professionals. However, as a fiduciary to the plan, one of the top items is to manage the plan within the legal framework where the plan is held. So sometimes these things are beyond the control of the individuals that are managing the assets. Taking it a step further, what we've seen has largely been a lot of distraction and a little bit of disruption to investment strategies. And part of what I mean by that is when legislation or we see proposed bills or bills that have been passed, there's a decent amount of interpretation that needs to be had. And we've seen a number of different flavors of bills come out. And if we use one where we've all seen come across a little bit more frequently recently related to restrictions in China, there's a number of different ways across states that these bills have been written. Some have a full blanket restriction or a proposed blanket restriction on exposure to China. Some will differentiate between direct holdings or indirect holdings, between active and passive, or between private and public. And depending on that language, it'll influence the disruption to a portfolio's investment strategy. Now, further, to take that one step further, plans have figured out how to manage this. It typically, from an implementation standpoint, is what managers or strategies have the flexibility or can customize my needs to accommodate this bill. And typically customization comes with a cost. So not only is there some disruption to the current investment portfolio construction process, but there's also typically a higher cost that can be associated with it. Now, taking us a quick step back, we have helped a few plan sponsors evaluate the expected risk and return impact from some of these restrictive legislative bills, either proposed or passed. And if you look at them in isolation, continuing with the example of China, while it is 30% of emerging market equities, it's roughly 3% of global equity. And for a plan that has 40 to 50% of public equity, that's about 1% of the fund. So in isolation, removing that exposure, we expect to have minimal risk return impact or an immaterial impact on expectations going forward, but it is causing a lot of time and resources to evaluate and to implement that. And so it's a slippery slope, right? And it's kind of learning and interpreting. And when there's open lines of communication, we tend to see that provide an easier path to implement some of the legislation coming out. But it's definitely been a lot of time that we've seen plan sponsors needing to take to make sure that they're implementing the portfolios within the right construct and right legal framework that overrides the plan assets.
Thank you, Katie. All right, we're going to shift gears and talk a little bit about monetary policy. And the first question is to you, Leo. Given the Fed's recent stance on interest rates and inflation, what impact do you foresee on public pension funds' performance?
Thank you, Hank, and thank you to your colleagues at NCPERS for the invitation to be here today. I think everybody knows or should know that the Fed maintained the rate at 4.25 to 4.5 yesterday. Chairman Powell stated that we're living in a highly uncertain environment. I think ultimately, as best as I can summarize it, the Fed lacked clarity and conviction to act, opted to maintain the status quo, monitor the situation, and essentially defer any interest rate actions to future meetings. So I take a step back and think, what if something else had occurred? Let's just say rates would have been cut or increased. I'm sure the market would react, move up or down, but I doubt that any of us in this panel would be calling clients right away and say, you have to change your asset allocation as a result of this Fed decision. So I think sometimes we may place too much emphasis on short-term actions and every meeting that the Fed may take or other central banks or other events. We know this will create uncertainty, but from there to affect a pension fund that may have many decades of life out, I think ultimately we may put too much emphasis on the significance, let alone the preciseness of those forecasts and what they ultimately will tell us. So if I think, 5 or 10 years out and look at a public pension fund, let's just look at the average one with, assumed rate of return of, 6.75, is 80% funded, receives his ADEC, has some gains to amortize in future years. I'm not that concerned. To me, it appears that the odds are pretty favorable. Pension funds will make, 6.5 to 7% over the next decade. Sure, if you have a major equity correction, that will, bring things into question, but that's why there is diversification. Granted, we may have thought to perhaps get rid of it. I know some investors have been questioning now for a number of years, given the very strong performance of the U.S. equity market, whether it's time to put more money into the U.S. I think this quarter may show us that, diversification still is a very, very wise investment action to consider and to maintain. So if I look at, the impact again, I don't expect many asset class changes. I would expect private asset classes to be at or gain some from, today, looking at 5 to 10 years. I think most of that will come at the expense of public equities. That will also reduce the expected volatility of a plan. I expect perhaps some marginal improvements in targets to real assets as an offset to higher expected inflation and a renewed interest in fixed income assets. If you look at this quarter to date, US down, but pretty much everything else is up. Developed markets up about 11%, China over 20, bonds doing 2 to 3. So as long as you haven't really turned your book to be heavily focused on US equities, I think even this short-term period will be okay and numbers will look good at the end of this quarter. Overall, I would say I'm pretty optimistic that during the next 10 years, the average pension fund will meet its return target.
Excellent. Thank you, Leo. Julian, similar question to you, but maybe with a slight different twinge here. So, should public plans adjust their asset allocations in response to, what the Fed did or didn't do yesterday? But maybe expand that out a little bit and talk about sort of the other central banks, ECB, Japan, etc. What do you anticipate from them going in the next 6 months or so?
Well, first of all, thank you, Hank, for the invitation, as well as thank you, Jessica and William. And Hank, when you had your crystal ball out and you were planning the timing of this webinar, I think you did a pretty good job of putting us right in the thick of it. I guess the only better date might have been April 2nd, the date that the reciprocal tariffs go into effect, but we're in the thick of it now for sure. In answer to your question, as you'd expect, we wouldn't recommend immediate knee-jerk shifts to meeting shifts in Fed policy. As everyone knows, the framework for asset allocation decisions for public pension funds and other institutional investors, my apologies if there's a little noise in the background, my former employer, the MBTA, the framework, the timeline is 10 to 20 years. And capital market assumptions for risk, return, and correlations for asset classes, of course, contemplate multiple shifts in monetary policy, whether it's the European Central Bank that you mentioned moments ago, or the Federal Reserve Bank over that time frame. And indeed, that's what we've seen. So really, your capital market assumptions, which are the framework for your strategic targets, contemplate these shifts. We wouldn't recommend, as you'd expect, any kind of attempt to time the market in terms of its reaction to Fed's meeting-to-meeting policy pronouncements. That being said, it is fair to say, and I think Leo referred to this a little bit, if we go back to 2022, the Fed embarked on 11 rate hikes to curb inflation, which was running at 9%. The Fed funds rate went up to middle single digits. Of course, the Fed doesn't control long-term interest rates. Long-term interest rates went up. And if you look at studies like the Horizon survey of investment consultants' return assumptions, on or about that time, you saw those annual return assumptions for fixed income tick up. Makes sense. Higher yields, yes, it's over a long-term period, but at the margins, that supported a bit of a shift, closer look at fixed income, because the risk-reward trade-off for fixed income is improved under that environment. And similarly, going back to, say, 2000 or 2007, when we saw a near zero interest rate policy where the Fed was trying to stimulate the economy after the global financial system crisis and in the thick of the COVID-19 crisis, that near zero interest rate policy from the Fed, with the understanding there's a broader context for making asset allocation decisions, but at the margins would have investment consultants having more modest return expectations for fixed income. That supports redeploying assets at the margins, not big amounts, to other asset classes that have a better risk-return trade-off in a zero interest rate environment. And so that would be my answer on that. I guess one other point is, when we see the Fed shift policy, we have to look at the broader context. So on the one hand, somebody might say, well, geez, the Fed's moving towards 2 additional rate cuts. Maybe 3 years out, they get down to the neutral rate or close to the neutral rate. That should be good for equities. But we kind of have to hold our horses there for a minute, because if the Fed starts to cut rates, which should be accommodative more rapidly than would otherwise be the case, it could be because they see storm clouds on the horizon in the economy, which would be a negative, all things being equal, for corporate profits, and that would be a cautionary sign for stocks. ECB looking at things similarly. They perhaps are moving in a different direction. Leo already pointed out, it's good to see that diversification is starting to pay off. It's conceivable that they'll move in an accommodative direction, but there's so many cross currents in Europe. I think I would be doing you and the panel a bit of a disservice if I tried to predict that with any kind of precision. So,
Thanks, Julian.
Yep.
All right, we have a next set of questions. I would like for each one of you to give your thoughts on them. And then after that, we will go to audience questions. So Katie, let me start with you on this one. And then again, I would like each of you to give your take. What do you think is the biggest financial or operational risk facing public pensions today?
Yeah, thanks, Hank. So one of the things that we're studying closely is liquidity risk, and liquidity is definitely studied. As Leo pointed out, we've seen a proliferation of alternatives and increase in allocations to alternative investments that was in the early 2000s was about 10%. It's now between 25 and 50% in some cases of public plans portfolios. And what we want to be mindful of when we're studying the liquidity risk is not just at a point in time and what it looks like in a base case scenario, but incorporating the cash flows of the plan. So understanding what the contribution policy is. Now, the biggest risk to a public plan is the contributions. That's when those contributions don't come in, that's when we see plans get into a lot of trouble. Now, recognizing the governing bodies over the investment portfolios don't typically have control over the funding mechanism, so they need to manage that risk. So understanding the cash flow profile and also understanding what that might look like in a stressed market environment, not just in a base case, but when we do see market drawdown and maybe an extended one, what does the liquidity profile of your portfolio look like at those times? Because that's when it's most needed. And so that's one of the things that we're studying as illiquids have grown. One other thing, another perspective of that, though, we think is a risk is kind of the opportunity cost. Most plans have some illiquids, but if you don't understand the capacity that you have, there's an opportunity, and you believe in the illiquidity premium and the benefits of alternatives, there's a risk you're not taking advantage of the added premium and the diversification that you can have. So there's two ways to look at it, but at the end of the day, it boils down to understanding how much illiquidity my plan can tolerate, factoring in your liability profile, your cash flow profile, and different market environments.
Thanks, Katie. Leo, what are your thoughts?
Yeah, so I think history has shown that the biggest threat and risk to any public pension fund has been a shock to the equity market. And so that is, in today's world, with all the noise and uncertainty in the economy, if at some point in time, it really begins to affect it, and you can see that, and consumer sentiment, the surveys are not looking great, the economy is, eventually that may make purchasers, the consumer and corporations be more wary about making buying decisions, purchase decisions. So you have seen from time to time other risk factors, changes in interest rate, but ultimately that's the biggest factor affecting performance for a public pension fund. So if you layer on top of that the fact that most pension plans are very mature now and they have negative cash flows, you combine a big drawdown with negative cash flows, that probably remains still the biggest risk.
Thanks, Leo. Julian, so liquidity risk, public markets, any thoughts from you?
Sure, I'm actually going to save some time here and get to the next panelist, because really I was going to, I couldn't have said it any better than Katie. And if I tried to, I won't look very good. I think liquidity risk is the #1 risk we think about, especially for cash flow negative plans. But I will put in a vote here for cybersecurity risk. Even though that's considered to be an operational risk, those risks find themselves into investment portfolios, fund transfers, and also they can result in reputational risks. And that's a real problem for a public pension fund or any financial organization.
Okay. Dan, you get the last word on this topic.
Yeah, well, I thought that was well said as well. I actually I truly like the idea of pointing out the illiquidity risk. We've seen this as an increasing trend of using illiquid assets to, again, provide the premium that Katie discussed, the added diversification and volatility control playing out and showing its benefit. So I think that's good. I think to take that a bit further, I think one thing, going back now the last 3 years, as we've seen with the rise to interest rates and other shifts to the real estate markets, is seeing not only the illiquidity as we understand it for some of the liquid investments that are taken on. But for things like core real estate and other real estate investments that have put up gates and created illiquidity and the inability to redeem, that's been a concern as well, that we've seen at this prolonged illiquid gates from these providers. I don't see that as a major concern going forward. I think, as Katie said, making sure that plans understand how to manage their cash flow needs and put parameters to illiquid investments is important. But from the investment markets, I don't really see a big concern. I think, we see a 10% correction in the equity markets. Maybe it's healthy. I mean, we've seen a very strong run from the U.S. equity markets here over the last 2 years. Now we have an appreciation for diversification and good rebalancing, and rebalancing, being the free lunch that we have in this industry, trimming profits from equities last year, using assets. And now I do think we'll see positive impacts from those other things, from those other asset classes where U.S. equity was so singularly leading the charge. Now we see bonds, we'll see international equities, and even see some stabilization from the write-downs on real estate, and ultimately those redemptions start to be made. So I think from the investment side of things, I think understanding those different items are important. I would say one of the biggest risks I also always see with public pensions is perceptions or misconceptions from the public. From the public arena of pension plans. They're always sort of viewed negatively. They're always viewed in some sort of sense where there's a misunderstanding. And I always want to reset that from a stakeholder standpoint, and that these are employee retention vehicles. These are recruitment vehicles. And I've seen this happen in more cases now, where we've seen some unemployment concerns in the sense that it's increased virtual workers and harder to recruit on the on people that have to be at work. So teachers or police officers or firefighters, harder and harder to recruit and retain. We've seen a lot of that turnover there. And I've seen a few plans that have even opened up recently to even allow to hire retirees back and other type of items. So those are items for the plan decision makers, the stakeholders at the plan sponsor level to work out. I think everything that we can do from the investment side to help ease those concerns is important as well. But that's a continued item, as that the public misconception of how pensions operate and the sincere need to use those as recruitment tools on that side.
Great. Dan, that's a great segue to the next question. And Leo, I'll start with you. So we've identified these potential potholes. What advice would you give to plans as they try to navigate these potholes? And again, understanding that, as you put it, Leo, we are long-term investors.
Yes, so I will revert back to an earlier comment. The macro future is unknowable. No one knows with certainty. Many of the most esteemed forecasters get it wrong from time to time. So I think the key is to build a portfolio that will be resilient in a multitude of potential environments. You get COVID, check. You have a crisis, it's going to be there. There's a rally, it's going to capture some of that upside. So to me, it boils down to diversification, but real diversification, because many investors may think they have it. They have large cap stocks, small cap stocks, private equity, high yield credit. It's all tied to the economic environment. So making sure that you have something that will be offsetting during time of crisis, that would go up, be liquid, allow you to rebalance, and then buy into those risk assets at a lower price would be very valuable.
Julian?
In terms of challenges and opportunities going forward, I think we don't have right now the challenge in municipal finances. I think on balance, cities and towns, local government jurisdictions that are funding public pension funds are in pretty decent shape. That can change in a New York minute. We saw that in the aftermath of the global financial system crisis. So I think for public pension systems, being ready for that, and I think NCPERS helps through fiduciary education and advocating for best practices, best governance, risk management practices, helps to be ready for the type of potential scrutiny. It's less of an investment risk. It's more of a finance risk, heightened scrutiny, and it's already been mentioned by Dan in another context. And, my experience, having worked in the public and private sectors, is that Many, really, I would say most, public retirement systems have governance practices, investment policies, disciplined decision-making procedures, transparency, that many private sector companies would do well to emulate. But it's good to get the word out there so you can continue to be autonomous, as Katie pointed out, in making those decisions for the best interests of members and beneficiaries.
Dan.
I agree with both those panelists. I think transparency is important. I think Leo's point about building a robust portfolio that's aligned with your long-term risk and return objectives, being unemotional, especially in periods of emotion. I think the key way we do that is by relying on our investment policy statement. We have a nice written Word document that allows us to control risk and return. And it allows us to remove emotion from the investing. So we set these long-term targets and policies and parameters. We can turn to this document emotional times and rebalancing again. I think the diversified portfolio and the benefits there, selling assets when they're when they've overappreciated and being able to rebalance those undervalued assets, and over the long term really reducing volatility and that's really, we have a nice healthy appreciation for diversification and rebalancing right now. So that's, we don't know all the uncertain things that are going to occur in the world. Clearly there will be unique opportunities, and there are unique elements and the market cycles that do become available and new investment opportunities. But on the whole, broad asset allocation really is proven time and time again that it's key to long-term success and allows for institutions to succeed where emotional retail investors fail.
Katie, you get the last word on this one.
I comment, leave it to a consultant forum to say the same thing 4 different ways. But I think these gentlemen said it all, right? It's stick with your process, assuming that your strategy has been set, understanding the different risks and rewards and potential outcomes, that it's been set to weather these storms. And so stick with the process, that it should well documented. And the other thing is that last piece is documented communication, and education is key to keeping that steady hand when you see these periods of volatility. Great,
thank you. All right, last question, and we'll begin with you, Julian, before we go to audience questions. Julian, how are public pensions incorporating technology, particularly AI, as we've heard so much about regenerative AI, or other data analytics into their decision making?
For AI, it's a little bit early days, I would say, to make any kind of bold, strong statements, other than to say that you're going to see, I think, public pension systems, as always, using good judgment, taking the features of artificial intelligence that actually can increase operational efficiency, improve decision-making, perhaps even our portfolio rebalancing. We don't know that, but that could be the case going forward. So a little bit of that, I know is a bit of a future-based answer. Technology and applying new data sources, one trend that's been underway for some time, and of course NCPERS has chronicled this, is more robust data analytics and evaluating key risk measures, whether it's the value at risk, standard deviation, the typical risk measures we've seen, to make disciplined decisions in monitoring investments, taking corrective action for a portfolio manager or an asset class where necessary, and also key performance and risk measures just drive disciplined, repeatable decisions that, quite frankly, you just have a richer body of information to consider when making well-informed decisions. And the last point I would make is there has to be some discipline in that. Just a quick anecdote, when I used to be on a risk management team, we were tasked by executive management to come up with a set of risk measures for them to make make decisions based on. I think we came up with 1,500 risk measures, and we were thrown out of the room. So the idea is to use technology, artificial intelligence, and good sound judgment to come up with a disciplined set of risk measures to support investment management and risk management decisions.
All right, thanks, Julian. Dan? Any
I think that's pretty well said. I do see, data and analytics being very key and important for how we not only review the factors that are impacting the markets, but also the factors that are impacting the plans at plan levels, composite levels, at manager levels. Also see it playing out more so in the investment manager decision making for how they may screen a universe for individual stock, bond, security selection, and it's very interesting to see the evolution of the different tools that are available there. And from the broad plan level, I do think all of us on this call, I think the capstone way in which we work with our clients is by providing ongoing performance reviews in very clear, objective, transparent ways. Simplicity is also key in that, the KISS process of providing this complicated analytics and breaking it down into very understandable pieces of information and illustrations that help trustees understand these factors that are going on in the market. So I think the ability to create more and more customized illustrations, charts, data, and graphs, breaking down economic data and graphs as well, economic updates into those types of pieces of tangible, palatable information has been very helpful. Technically wise, I do think what we're seeing with the investment managers, particularly those in the private asset area, very sophisticated approaches to identifying, modeling, and implementing investment strategies.
Katie.
I don't know, I have too much to add to what's already been said, which I agree with. I think one area that we may see some benefit is on the administrative side. You've seen the AI meeting notes tool on Teams, and for some plan sponsors that may have a limited staff where they don't have where a lot of resources are needed, right, to manage this level of assets, but kind of being able to summarize key takeaways or meeting notes and document that, I think that might be a benefit that we might see the public plan sponsor space take advantage of. But I do think it will probably be somewhat of a slower uptake, just because there is such a strong governance model and approach in this space to make sure that whatever is adopted, that there are controls around an understanding of how the data is being used, and that making sure it's being used in the appropriate way.
Great, thank you. Leo, last word.
Yeah, very quickly, I think the use of AI for digesting a lot of research. AI can provide summaries. We'll have to be cognizant that there could be errors, but in general, I think that is a way to get a sense of a broad amount of research in a much more efficient time. I think you'll see more use of newer technologies in asset allocation analysis that will lead to better scenario analysis, stress testing, and ultimately better risk management.
Great. All right, so at this point, we're going to shift over to the questions from you, the audience. Again, we have about a dozen questions from the audience, but if you have a burning question that you want to ask this panel, as you know, this is free now, but it may cost you if you ask in the boardroom. So we encourage you to use the Q&A function and ask the burning question that you have. So first one, let me throw it to you, Dan, and then I'll also ask others to give any feedback. Expectations for private equity returns. Do you expect mean reversion, and if so, to what return?
I wouldn't say I would expect a mean reversion in the sense that there may be a pullback of sorts. I think again, private equity and also on the private credit side, you do have a benefit of having a removal of daily volatility from that equation. I do think the long-term trajectory of private equity will produce double-digit returns. Private equity more so than other asset classes, where you will see, I do think, differing returns from different managers. I think access to deals is important, but I think we'll still see a sustained double-digit return in a way that's going to provide a nice volatility dampening, diversified component to a program. Now, with that said, there are a lot of aspects that need to be evaluated when venturing to private equity, and that's having a very methodical and intentional pacing structure, that you understand how you're building out your private equity program, the managers that you're going to be evaluating through that process, and putting it together in a way that's, also sized in a way that it doesn't create illiquidity drags on the remainder of your public assets, but within the context of a well-defined, well-structured, strong management team for private equity, I don't think we'll see a mean reversion. We'll see, new vintages come up with new opportunities. Some will outperform other, but that's why you have that diversified approach. But you'll see, double digits, sort of maybe mid double digit rate of returns over the long haul, 10 to 15 years out from a private equity program.
Great. Anybody else have a thought?
Yeah, I might just, I would echo what Dan said and add two things. One is that just manager selection is key here, right? And you need to be able to find those skilled managers, because the differentiation between a top quartile and a median manager is quite large. But we have seen some compression in premiums of private equity relative to public equity. I think our expectations are roughly 200-300 basis points, kind of on a median expectation of premium over public equity. But you may recall 10 or so years ago, plan sponsors were adding 8%, 5% over public equity. That premium has come down some to 1% over public equity. And then it becomes a conversation with the board and tolerance. What's worth, what premium are we requiring to lock up our illiquidity? We still think that it's a return enhancer and there's premium to be had, but I do think we have seen it come down. It's become more competitive. And we do think we'll see more differentiation between those top private equity managers and the bottom private equity managers.
Great. All right, next question. Katie, I'll throw it over to you. What may be the cost of the new immigration policy on the economy?
Oh, that is a tough one. I think it might be a little too early to tell to see how the policy ends up coming into implementation, right? There's been I've heard some different takes on what the impact may be. While negative is kind of the initial reaction that it's going to make costs higher, there's going to be an impact on the labor market. There's also the other lens that certain areas are becoming less dependent on manual labor. It will enhance the technological, the AI, the efficiency. And so there's a balance there, but on how quickly and how, depending on the different areas that labor is impacting, that can shift is also a factor as well. So a little bit of a TBD, but I think there's some concern on how immigration policy actually plays out and then what the impact is on the overall economy.
Thank you. Anybody else?
I would just add, it's obviously labor markets, just like other markets, not to be too clinical, but it is a matter of supply and demand. So if immigration restrictions are implemented, they shrink demand. We have a labor market, as we do today, with a robust economy, 4.1% unemployment rate. You'd have to assume it would drive up the cost of labor, obviously more focused on some industries, less so on the others. And I will say the optimistic side of me, and this applies to trade policy as well, says that if immigration restrictions are implemented carefully, with more precision, like a surgeon would use, or somebody very carefully, the impact doesn't have to be as large as it otherwise would be if they're abrupt, just like tariffs. That's more uncertainty, and that also hampers the planning process for many of our great companies. So I do think implementation is a big question that will help us see what the future looks like in terms of the impact.
Great. All right, let me go to the next question, and I think I'm just going to just ask one question per panelist, as we're getting more questions and we want to be answering them. Leo, please comment on the most recent long-term capital market assumption, 20+ years outlook, and expected long-term returns.
Yes, we recently produced those, as most other consultant firms do, typically once a year. Ours came out on the 4th week in January. I would say not a lot of changes from the prior year on the aggregate, as equity valuations in general moved up. Certainly in the US, forward-looking returns came down. Overseas, less of a change. Interest rates went up, so fixed income and other asset classes that derive some type of cash yield to their return stream move up. So when you net those, we didn't see dramatic changes from 1 year to the other, so that whatever you were projecting about a year ago appears to be within line of what you would do if you use projections 1 year later. So long story short, not a big change compared to other times, for example, in 2022.
Great. Thank you, Leo. Next one to you, Julian. What asset allocation do you advise? Parentheses, equities / fixed income / alternatives / cash. Close parentheses, question mark.
What do we advise? Well, as one might expect, all of the above. And obviously, in a diversified, balanced attack is the way to position a portfolio to maximize its chances of meeting or exceeding the return assumption, whether it's 7% or modestly higher or lower for the benefit of members and beneficiaries. If it's a question about change, we've seen, as Katie pointed out, if you go back over the last couple of decades, more allocations and greater allocations to alternatives that where the plan sponsor can tolerate the liquidity risk, because it does create a more efficient portfolio. You're simply getting returns from different parts of the capital markets to get to a higher risk adjusted return. So I'd say continuing to look at alternative investments, but sticking with a balanced attack, using the capital market assumptions that Leo just referred to as the framework for making good disciplined decisions. But again, with expected returns for public markets, a little more modest than they have been by historical standards, that argues in favor of giving alternative investments that have the right risk and return characteristics and reasonable fee structures, of course, a good hard look to continue to improve efficiency for the portfolio over time.
Great, thank you. Next one, Dan. How will the imposition of tariffs affect the pension investment environment in both the short term and long term?
Yeah, so I mean, that's a very good question. Obviously, tariffs have been, one of the front and center items that have kicked off this current period of uncertainty. I do think that might have been one of the key drivers of creating this uncertain environment. And Julian already made the reference to April 2nd, where we're gonna, hit the reciprocal tariffs and this trade war process, creating concerns both domestically and internationally. However, uncertainty is not good. Investment markets don't like uncertainty. Stock market pulls back 10%. But I also want to, again, reset and focus on the fundamentals of modern portfolio theory. When the stock market's up, 26%, 12 months, a pullback is typically, a reasonable thing to expect. The stock market may have gotten a hold of itself. Maybe this is the reason that gave the catalyst for this pullback. But I don't think it will lead to a prolonged shift and concern for economic growth. Meaning, what we'll have is a period of uncertainty. If you are a small business owner and you were thinking about starting a business, you might, or deploying some serious capital and some sort of investment operation, you might hold off until you get some clarity on the tariffs. So there might be a pause through this uncertain environment, but at a certain point, confidence will be restored and understanding, where the dust has settled, and we'll see, economics and we'll also see investment markets get back on their course. So I'd be cautious to make any investment decision to the program as a result of tariffs. I think tariffs, trade war, and also, again, the focus on cutting government spending have all been things that have been a catalyst for causing or bringing forward this market pullback, but don't think they will lead to long-term structural challenges. So I think, again, holding to the investment program. I think one item that's been very telling about this, and Leo pointed out earlier, just a sort of understanding of market dynamics, is that trade war and tariffs, it does goes both ways, and there's currency elements to it. But what we've seen over the last, this quarter to date is U.S. markets down over 5%, or around 5% negative, U.S. equity markets, excuse me, and international markets strongly positive. So I think that tells me what we're also seeing is not only a result of tariffs and that uncertain environment, but it's also just a repricing of the asset classes, because U.S. equity markets were way ahead of themselves. things like bonds, real estate, international, now catching up through, again, diversification in the program. So I don't want to dismiss tariffs. I don't want to dismiss trade policy, Fed policy, or any other items. They're all very important catalysts to understand. I can understand why they create periods of uncertainty and slow down some investment decision making. However, long-term structurally, I don't see a significant impact that markets and the economy can't weather once they figure out how the dust will settle.
Katie, let me combine a couple of questions for you. What do you think is the biggest investment risk facing public plans? And then layered with that, what about prospects of possible war with Russia, China, or Iran?
So I'll take the last one first because I don't have an answer for that. I think it's something that we can't rule out, right? I think our view is that it's probably a tail risk, but it needs to be, when making investment considerations, part of that. It is a very real risk. The likelihood or probability of that, I'm not going to try to put a number on, but it's something that's certainly become more of a topic that we're speaking about and considering in boardrooms, and has been part of decision making on where to invest. And this geopolitical risk is taking that risk. Is there a trade-off? Is it worth the potential reward of owning that risk? And sometimes that's a tolerance and a preference decision of a board or a system on the tolerance of that potential risk and how big they think that risk is. So should be considered. We think it's a tail risk, but a risk nonetheless that has risen recently. The biggest risk to public pension plans, I think if that was the question, we kind of touched on this, and so I'll try not to repeat that answer, but I think liquidity risk is something that we're just being more mindful of. And one other aspect of that we didn't mention earlier is that most plans are maturing in size, and most plans have a negative cash flow position, meaning they're paying more benefits than they're getting contributions into the plan. And so again, thinking of the investment strategy, being aware of that and being aware of what that might look like if we do get a market drawdown or in a stressed period of time, as potentially the cash flow profile becomes even more negative, whether it's 2% now, but if it's 5 or 6% in the future, that's something to be aware of as you manage your illiquid portfolio. And it could be just fine, but it needs to be the strategy needs to be set in that context of looking forward.
Great, thank you, Katie. Next one to you, Leo. As a trustee, when we are brought another fund, new vintage year, how much faith should we put into the performance of previous vintage returns, or should we always look at similar types of products and compare overall manager trends?
It's a good question. I would say in the public markets, the persistence of performance is not good. It's pretty much irrelevant. So that just hiring a manager based upon past performance is unlikely to provide any good return. It may or it may not, but there's no way of telling. So it's almost like flipping a coin. On private markets, some research shows that there is some persistence. And so from that perspective, I think it has to be accounted for, but you need to look beyond that. So was the environment the same? Are the individuals that made those decisions in the past still there today? So it's a lot more than that, but at least it's a good starting point. And in addition, you want to look at a cross-section of other funds out there, because maybe the fund did okay, but others did a lot better. And you only have enough space for one. As Katie mentioned, there is a wide dispersion of returns. So that's why it's challenging, and that's why you need to build the resources internally or hire somebody on the outside who does have those resources and experience. Finally, I think it's critical to look over a full cycle. So if you look at credit, for example, we have 15 years or more of a one-way environment. A lot of the managers that have been fundraising over the past 15 years, perhaps starting then, they haven't gone through the other side. You want to see how they would perform in an adverse environment. So from that perspective, there's no easy answer, but it takes a lot of effort, and that's why it's somewhat more expensive. It just takes more manpower and more resources to try to find the right strategies.
Right. Next one to you, Julian. Considering the differences between active versus passive investment management in public equity side, what are some of the important factors to consider this year when considering active management?
Well, I think they continue to be the same factors, active versus passive, which I think everyone knows is the market they're investing in, whether it's small cap value stocks, large cap growth stocks, which of course is a much more efficient market, or non-US markets, which are a little less efficient. What are the inefficiencies in that market? If there historically have been inefficiencies in those markets, have there been changes in our economy or markets which will compete those inefficiencies away? So I don't know that anything is happening right now that would change our point of view on active versus passive. It's more driven by the efficiency in the market, the ability of price discernment or price discovery to actually add value by the manager constructing a portfolio that's a subset of the index that will outperform over time through market cycles, very importantly. And those opportunities are far better or materially better is probably a better way to put it, in the less efficient parts of the public markets. Small company US stocks is an example. And of course, those inefficiencies are definitely more prevalent in private markets, as evidenced in part by the wide dispersions of returns of managers. Everybody is thinking about this, so it's unavoidable to not mention the Mag 7. If the Mag 7 stops having such a disproportionate impact on returns, those 7 technology stocks that dominated in 2023 and 2024, is there a better opportunity? Can an active manager, even in large company stocks, make a case that the opportunity for active management is better if we move to a broad rally in stocks? And in fairness to active managers, I'd say the answer is affirmative. Probably make the case that there is a better opportunity. They deserve a hard look. Clients who have tolerance for tracking error risk, active management makes a lot more sense. It's what is your tolerance for tracking error risk? In plain English, variability in the return stream relative to the index. If you have high tracking error risk tolerance, then active management across the board at least deserves a hard look.
Right. Thank you. Well, we are almost at the top of the hour. Thank you, everyone, for these great questions. I'm afraid we can't get to all of them. That's the bad news. The good news is Katie, Leo, Dan, and Julian will be joining us again in person at our annual conference and exhibition, also known as ACE in Denver in May. So we'll save your questions, the ones that we didn't get to today, for that session. And so with a minute left, let me do a couple of quick lightning round questions for each of you. So again, as I mentioned, we'll be meeting in person at ACE on Monday, May 19th in Denver. Where do you think the S&P 500 will be when we meet again? As a point of reference, at 1 o'clock Eastern today, it was around 5,660. I'll start with you, Katie.
Oh, same place.
All right, Dan.
I would say we're May, we'll see a slight bounce off these levels. So I don't know, put it up, 3%. So I'll call it 5750 or something around there. But I'd say still slightly negative. We'll call it flat for the year. So
Okay.
There you go.
Flat. Okay, Leo.
Where we were January 1st.
I'm throwing a dart here in the dark, but I'm gonna go with 1% positive for the year.
Okay, Julian.
All right, the clock didn't run out, did it?
Not yet.
I'm going to go 3% positive, and
All
so
right.
that puts me at the outside.
All right. All right, and then the last lightning round question, more tongue-in-cheek. We are in March Madness. The NCAA tournament started today. When we meet, which schools are we going to be celebrating as champions on the men and women's sides? Again, as a point of reference, South Carolina and UConn are the favorites on the women's side. Duke and Florida are the favorites on the men's side. Leo, I'll start with you. Women's NCAA champion.
Gosh.
Go with the favorites then.
The favorites.
Julian?
Okay, not men's. UConn for the women.
Okay. Yeah. Oh, I'm sorry. Yeah. So give me your both. So
yeah, we'll have to go with
you-
Rick Pitino and St. John's for the men's.
All right. I like it. Dan? Women and men?
Well, I don't want to be too polarizing on here, but I have to go with my alma mater, the University of Florida, Fighting Florida Gators, on the men's side. So go Gators. And on the women's side, I'll root for the other SEC school and go South Carolina.
Nice. Katie?
UConn and Duke.
All right. Leo, I forgot to ask you on the men's side for you.
Let's just go with Michigan State just to be different.
All right. The correct answer is Wisconsin on both, but everyone, thank you so much for joining us. It's been a great, fun inaugural session. Thank you to Dan Johnson, Katie Comstock, Leo Festino, Julian Regan, and of course, all of you for joining us today. And again, submitting those wonderful questions. We will see you next virtually at our April 8th webinar on the 2025 proxy season, key votes for pensions to watch, and in person in Denver at our annual conference and exhibition, ACE. Thank you, everybody. Take care.